Good morning, everyone, and welcome to this sunny Saturday morning. We're going to get started in about 4 or 5 minutes. My name is Rod McClary. You're going to be hearing from Philip Tonge today. Your microphones won't work, but chat works well. Anything you write in the chat, I see, and Philip sees, but it's not open to the public, and we'll respond to you as soon as we can. Sit back, enjoy. See you in a bit. Good morning again, everyone. My name is Rod McClary. Welcome to our presentation on this sunny Saturday morning. We're going to get started officially in about 5 minutes at 10:35. We're just giving everyone a chance to log on, so sit back. Your microphones have been muted. However, the chat works, and you can put questions in chats, which we'll get, and we'll answer the questions as best we can. And I'll also put a link for you in the chat showing a way of booking meetings or talking to us afterwards. So sit back, enjoy the meeting. Please use the chat. Let us know if you have any questions. Hello again, everyone. We've got 2 more minutes to when we start, so it's time to top up your coffee. Welcome again. My name is Rod McClary. Philip Tonge will be presenting to us today, and we'll be starting in about 2 minutes. Sit back and enjoy. Good morning. Again, I'm Rod McClary. I want to welcome you all to our presentation on this Saturday morning. Philip Tonge is on with us, and he'll be talking today. Your microphones are muted. However, you can send us questions through the chat. Please do. I'm making note of the questions. Phil will answer the questions if he can at the end or even during the presentation. but we're keeping a record of all of your questions. Also, I'll be posting in the chat for you, occasionally right through, a link to reach us after the presentation. So with that, I'm going to turn it over to Phil and enjoy the presentation.
Thank you very much, Rob. And thank you all for joining us on such a lovely Saturday. And we're not going to take too much of your time, so you can get out and enjoy one of our first very beautiful spring days. I'm happy to see so many people register, and that's why we gave a little extra time to log on. We have a full house here, so I really hope that you get a lot of good information from our presentation today, and some things to take away with you and sort of ponder about. As Rob said, any questions that you have can go into our chat section. You'll notice videos aren't working, and your mics aren't working, but also the chat is private between you and Rob. So if there's any questions or anything else about registering, please by all means send it through there. And at the end, we'll have a bit of a recap and answer any of those questions, but we'd happy to do so anytime after the presentation as well. So to get started here, just wanted to give you a little bit of our agenda. So first, just want to introduce who we are and what we do in our practice. You've met Rob, my co-partner there. He's the McCleary and Tonge McCleary, and we'll sort of go over our team. One thing that a lot of people and a lot of our clients currently have on their mind is the current market conditions and what we're seeing in the world today. And that will blend into our retirement talk, because of course, what we're doing with our money and how it's invested and everything else will lead to a lot of questions about what we should be doing to make sure that our retirement planning, whether or not we're in retirement or we're approaching it, making sure that we do have quite a bit of confidence. So you'll see building confidence is going to be a theme throughout our presentation. And then I will go through our approach and how we go through all the different areas of your finances to make sure that you are confident no matter what the market conditions are. So just to get started, I wanted to give a little question here that really I find interesting, and if you ever go through this at cocktail parties and such, it creates a lot of debate. So the question here is, how many holes does a straw have? The answers to choose from are 1, 2, and 3, or sorry, 0, 1, and 2. And at the end, I'm going to give you the answer. But the reason I'm starting off with this is because this question actually leads me to a lot of thoughts about financial planning. And I'll explain that all at the end when we go over the answers to this. But make sure you stay tuned to the end to get the answer and how we look at this in terms of your overall financial planning. Our team, as you've met, Rob McCleary and myself, been working in the industry for over 22 years. We have a large private wealth practice. We deal with approximately 300 families, and they come from different backgrounds and businesses and own their own businesses, professionals, medical professionals, and people of all different backgrounds. And so we utilize our financial planning experience to help people in all different kinds of situations. Our team behind Rob and myself is our client service team. And we've built a comprehensive team to make sure that our clients are getting the best level of service that's available to them. Robert Baker, Rima Jane, our licensed financial planning associates, Deanna, our client concierge. And then you'll see a number of specialists that we bring in depending on the kind of things that we're putting into financial plans. So Many people are dealing with mortgages or lending products, and we have someone that is an expert in that area, Jenny Ho. Our wealth planning specialist helps us look at other the world of different financial products out there. And sorry to go back. Steve McGinnis was our insurance and estate planning specialist that helps us look down the road and our risk management. Sorry to pop ahead there. We also have a team of experts in the areas of tax and law, and they support us in a lot of our complex areas. So we have over 20 lawyers and accountants that work with us, and you'll see some of the areas that we get into within our planning. There really isn't anything we can't touch on, and we deal with this on quite a regular basis. So whether it be executive compensation, cross-border issues, succession, marital breakdown, unfortunately, philanthropic planning, always have a hard time with that one, corporate and personal tax, legacy, and of course, retirement income planning. So maybe you follow it closely, maybe you don't, but we see a lot of volatility in the markets these days, and there's a lot of questions about what's going on in Europe, about inflation, about interest rates. There's quite a lot to take in, and nobody likes looking at their statements and seeing the markets going up and down. But in fact, this is something that if you're planning for the long term, this is something that we know that we need to expect. But I wanted to sort of address this elephant in the room, because the last couple of months, especially with what's going on in Europe, has heightened our anxiety, if you will, about what this means, especially coming out of our pandemic. So I have a small little recap on a market outlook from our chief investment strategist. And this is just a couple minutes video talking about what we've seen and how it relates to the portfolios that we're managing, and some things that you can take away from this.
As I reflect on the first quarter of 2022, 5 key themes emerge as drivers of performance. These are inflation, rising interest rates and rising interest rate expectations, the correction that we saw across many equity markets around the world, the war in Ukraine with Russia, and higher commodity prices. And each of these 5 themes are interconnected. Starting with inflation, what we saw in the first quarter was the highest inflation in Canada and the United States that we've seen on a year-over-year basis since the early 1980s. That has led to the second theme and prompted central banks to raise rates. We started to see the Bank of Canada raise rates. In fact, as we're recording this, the Bank of Canada has a 50 basis point increase to its overnight rate. But in addition, we saw the Federal Reserve raise rates, and the tone out of the central banks has shifted from a more dovish perspective to one where we can expect interest rate increases through the remainder of 2022. But not only that, we saw interest rates rise across the bond spectrum, across maturities, and as interest rates move up, bond prices fall. Those two things, inflation and a rising interest rate environment, led to the correction that we saw in equity markets in the first quarter. In the United States, the S&P 500, benchmark for U.S. equities, fell 13% between January 3rd and March 8th. In addition, the NASDAQ Composite Index fell by 21%, extending that correction into a very modest bear market before each index regained more than half of the losses by the end of the quarter. But the equity volatility was spread around the world. We saw volatility in Europe as well as the emerging markets. Part of the volatility that we saw in Europe was brought about by the conflict in Ukraine by Russia. Now, this has created volatility not only in Europe, but elsewhere in the United States and other markets around the world. But in particular, created volatility in the commodity markets, our 5th theme or 5th driver of performance in the first quarter. We saw energy prices, oil in particular, move up to over $120 a barrel in March. We saw natural gas prices move up. In addition, soft commodities like wheat, corn, and fertilizers all moved higher as a result of the war. Now, Canada was an ironic beneficiary to this. The TSX tends to do well when oil prices are up. And what we saw was the TSX outperformed its global peers, hitting a new high on March 29th. Overall, when we look forward through the remainder of this year, we're actually quite encouraged. There have been many headlines speculating as to whether we would see a recession in 2022 or 2023. We don't subscribe to that. I actually think that the recession risks are quite low for this year and into next year. The data would actually support that. Unemployment is quite low in this country and in the United States. Housing activity is quite strong, and we have a very healthy. Consumer. So my advice to investors as we consider the remainder of this year and as we think about 2023 is to put aside the headlines, to put aside the geopolitical risk, which is proven over history to be a poor indicator of market performance, and focus on the fundamentals. Here, we would argue that the fundamentals, especially following the correction that we saw in the first quarter, have improved materially since we started the year.
Thanks. Thank you for your patience with that. I'm sorry if anybody had any trouble hearing that or anything else. If you want to send a note to Rob, we can also send this after the fact if you wanted to hear some of the areas that might have cut out and such. But some of the key points that I just would want to touch on that were in that presentation was the discussion of inflation. Of course, this is such a big thing on people's minds right now, understanding where inflation is, and it's taking money from our pocketbooks, and is this here to stay, or is this something that we're looking to tackle? And of course, interest rates. What we're seeing now is you're seeing central banks having more of an aggressive approach to interest rates to curb inflation, but we also have to make sure that they do so at a pace that's not going to send us into something along the lines of a recession or anything else. The equity market corrections that we touch on are something that's natural after a large year that we saw coming out of the pandemic, and with a lot of people putting a lot of money into especially technology-driven areas. So that was a something that we could see on the terms of corrections. And I'm going to show you some slides about how common equity corrections are and such. Of course, the Russia-Ukraine war is going to have a global impact in some ways, but as Philip Peterson said there, that Canada is a beneficiary of this in the sense that a lot of the commodities and the things that Russia supplied the world, Canada also is a big producer of. And so Canada is actually positioned to pick up a lot of that slack. And then that leads into commodity prices, which essentially we see that in our inflation, building supplies, everything else, oil prices and such, that all of these things are sort of interconnected based on the timing that we're in. But I want to put things into perspective here, so you can maybe take a little, feel a little easier, because the anxiety we always have in the moment is always worse than anything we've gone through in the past. When we look in the past historically, we think, oh, that was bad, but it always seems worse right now. And if we look on the history of geopolitics and we look at, we plot the markets and such in the future, we see that the markets have always weathered these kinds of storms, and that there's always been a lot of geopolitical risks out there, or something that you think could end up leading us to either recession or into some sort of economic crisis. These things aren't new. And when we put plans together, we have to account for the fact that these things will continue. We don't know what they are. And that's the thing with geopolitics, is that we don't necessarily see them coming or what the actual impact's going to be. But if you say that I'm going to retire, and in retirement, I need to live off my savings, or I have a lifestyle I want to live for the next 30 years, we can't just assume that once this current crises or events are over with, that nothing is going to happen. So we need to account for that in the future. If I want to take a look at the recessions and how the economics and the geopolitics play together, I see a lot of the same sort of scenarios. And the blue lines there are the recessions that we have gone through. I always find that the word recession it's an economic term, and it's something that they throw around on the news a lot as, oh my God, here comes a recession. But if the economy contracts by 0.1%, or if it increases by 0.1%, does the average person out there feel that difference? It really, a lot of these things can be subjective in terms of the portfolios and in terms of your own lifestyle and such. So outside of looking at recession and geopolitics, I think people nowadays are more concerned about what's hitting their pocketbooks, which are higher prices and interest rates and such. But those kinds of things are normal economic cycles that we look at. But even coming out of recessions, here's some good news. When we look back at some of the biggest market corrections or market crashes, if you will, in the past, what we see is, we see the big loss in our returns in all of these times. So we've listed, 6 different events here that have happened. Of course, 2020 isn't on here yet because we're still seeing what's happening coming out of that downturn. So if we go back to the financial crisis, which, at that time, it was dreadful. The entire world economy was going down. The TSX in Canada, we didn't get a hit as hard as the US, but we saw a 33% decline in values. That is also comparable to the decline that we saw in March of 2020 when the pandemic really started to take its hold. But if you look at the afterwards, the market returning, the 12-month return following that bottom was 35%. In 2020, we saw that to be even more. We see that the markets come back basically very comparable to the amount that they actually went down. And then if we look at our 5 years following that, because what I like to say is these market corrections and downturns like to shake out the trees of speculation. Essentially what you're seeing is that's a big opportunity where we see a large amount of gains in our portfolios, a large amount of increase. The real question is, how do we react, or how does the average investor out there react with their savings, especially when the emotions are involved? So if I have a nest egg and it goes down by 33%, I don't want to lose any more, and I might be panicking at this point. In retirement, this is a very true event. This is a very, very real emotion, because you're not saving anymore generally. And this is money you have to live off of. I don't have employment income coming in that I can wait out the storm. I have to take money out of my RSPs or my other investments to fund my lifestyle. So a lot of people will make the decision, or they'll panic, and they'll end up selling at the bottom of that minus 33%, let's say. And when do they feel comfortable getting back into the market, saying that this is over? Well, that 35% bounce back doesn't doesn't notify us all that it's going to happen. A lot of times it's a big swings in the market, and it's a seesaw. It's up a bit, down a bit, up a bit. But over the next 12 months, we see something like a 35% increase. And if we sat on the sidelines because we were too worried about losing more, that has a detrimental effect on our portfolio. So we have to keep things in perspective. If I make it even easier to say that even on a growth side, now this is just the TSX. So this is a much more growth oriented type of investment to say, if I was just buying the markets, which we know are volatile, and it's not going to be a well-balanced portfolio or anything, but even the TSX, we say that in any given year, we have roughly a 70% chance of having a positive year. A lot of people, whether or not you're into sports or I don't necessarily like to use gambling and such, but if you look at a 70% chance of winning and a 30% chance of losing, that's a much better odds than in most gambling or anything else. That usually seems like a pretty reasonable bet and such. But of course, if we use a well-balanced portfolio, we can do much better to really mitigate the impact of those negative years. So when looking at your retirement and what today's retirement looks like, of course, it's important to understand that financial planning and the best way of building confidence in your retirement is looking at all the different areas of your finances. It's not just how my investments perform. And retirement planning isn't just I put in $10,000 into my RSP each year and we'll see what happens. We want to take a look at all these different areas of your finances and actually keep a constant eye on how these different areas are going to impact you, also within terms of your goals. So retirement optimization is one. If you're self-employed, that's when we look at how the business relates to your income. Major expenditures, whether it be something planned or unplanned. I want to help my kids buy their first home, which is quite common these days, or funding education for younger kids. Most likely needing a new car every number of years, depending on how long your cars last. Sharing wealth down the road. These are all very important things to keep your eyes on, and this is what your team needs to be doing on a regular basis. One thing that we all have to look at is that we're seeing that people are living longer in retirement. So if I'm retiring at the age of 60, and we say statistics of, a man will live to 83 and a woman will live to 86, congratulations. But actually, when you look at statistics, the chances of one of them living into their 90s, that means that somebody who retires completely at the age of 60 has to provide income for 30 years. So that means that we need to take considerations for how our investments are going to produce that income and what we're doing with it, how inflation impacts, and the kind of lifestyle that we want. So when looking and understanding based on research, we find that a lot of people are quite worried about how long these funds are going to last and what can I draw on. I know that government benefits, CPP and OAS, is really, it's a bare minimum. It's not necessarily enough to live off of. And for people now that maybe, you own your house and it's worth a lot, but do you want to sell your house to have to cover a shortfall or medical expenses or anything else? But then we get back to that ugly inflation that we're seeing nowadays. Now, of course, it's historically high, but how do we account for that? If inflation was to stay at this level, we're going to be chipping away at your investments or chipping away at your savings a lot longer. So how can I be comfortable in today's environment? How can I be comfortable traveling, living the lifestyle that I want, when I know that I could be living and need money for around 30 years. This is something that we've all felt and something that we've all seen time and time again. We know, and we all can be nostalgic and think back to when we were younger and how much prices were then. How much are prices going to be 30 years from now? How much is it going to cost to fill my tank of gas in my car, or simply food, supplies, heating, anything along those lines? So simply saying that I need to put my money away and hope for the best may not be the best way of building that kind of confidence. We need to look at the things that really do matter. One of them is that people don't understand is what we call our sequence of returns and such. Often clients who come to us have done some very rudimentary planning, probably with their bank or that type of an environment where they do some very basic looking around, and they simply would say, oh, this is how much money you have. And so in this example here, say like, oh, okay, I have $100,000. And if I was to get 5% rate of return and I was to take out $600 a month, how long is that going to last? They say, oh, well, that's going to last until you're 89. Okay. Well, whether that's 100,000 or whatever numbers you want to work with, is that number 89? Is that real? Am I going to get 5% every single year? Not likely. And I think we would all agree that volatility plays a part. So let's see the risk that volatility strikes. So these are a little bit more of extreme examples, because the kind of investments that we would be using in somebody's retirement wouldn't have these kinds of swings. We'd be doing everything to mitigate this. But what you see here is a 5% average rate between a sequence of returns. So let's say in the first year we get 5%, but then we have a market correction of minus 15%. And then the market rebounds and moves on to 25%. So I have a 5% average rate of return. But simply accounting for that kind of volatility, my 89 is now down to 83, because they do have an impact. Okay, well, let's take another look. Let's say that we have stronger returns. Again, this is 5%, but we get 5% in that first year. And instead of going down right away, we get another strong year before a market correction of minus 15%. How does that do? That should be better than my 89. I had strong returns each year. Well, that's still 87. So as you can see, that 89 is not necessarily something that I should count on or can count on. And when I turn on the TV or I see what's going on in the marketplace, there's no guarantees. I see volatility. So what can I count on? I went in and I say, oh, I looked at another kind of sustainability, and I try to use a more of a balanced approach portfolio and such. And so in this example, we're saying, okay, a hypothetical rate of return of 5.9%, and I take out 5% each year, and look at that. I am able to get to a level just under 100 years old, and this is how much I can take out, and that's great. But as we just saw, that doesn't necessarily tell the picture, because we know that 5.9% is not going to happen each year. So what we're able to do is say that, okay, the kind of investments and the kind of things we're going to put together, we're going to look at volatility testing. We're going to look at standard deviation, and then we're going to basically run it through hundreds of different market scenarios and say, what is the most optimal mix, and what is the actual chance of me hitting that 9, that that 5.9% and lasting to 100. And you can see the volatility and the standard deviation shows both exceeding that amount or falling short. But I think it's important to understand what is going to impact where we end up on that spectrum. One of them is looking at every single year. This is showing the amount of declines we had in the market on each year and where the markets ended up. So as you can see that at each point, almost every single year, the market had a pullback, a correction, or even a crash at some point every single year. So what really determines where we end up on that spectrum is how we react in each of those market conditions. So if I was going to use this year as an example, and the markets are down 10% this year, do I want to say, oh, I'm going to try to time the market? I need to get out of the market. I need to get out and let this settle. And I just can't handle this kind of volatility, and there's war and there's COVID, and this is different. You've probably heard that before. It's different this time. Well, what you're actually, those kind of decisions really have that kind of impact. If I'm selling out and I'm changing my whole investment directive every time the market goes down, then I'm actually compounding those losses. And that's what's going to make me fall short. So it's important to see that pullbacks and advances, it's very common. What you need to think about is, am I invested in ways that I'm comfortable with and in things that are that I know are going to be doing well? So for example, you say that, well, am I invested in Bitcoin or cannabis stock? That's speculation, in my opinion. And the volatility will match that. Or do I think that 5 years from now or down the road that big banks, Royal Bank is going to post profits year after year, or Apple's going to keep shipping iPhones, or oil companies are going to continue to make money? Is Imperial Oil going to be around in 5 years? Is Royal Bank going to be around in 5 years? Are they going to continue to make money? Even though we see their price go down by 10% in a year or maybe more, are they going to be consistent, or are they going to continue to grow in value? Well, one thing I can tell you is that no board of directors is going to allow a CEO to have more than a year of negative earnings before they're really changing a lot of their management. If they want their $20 million bonuses, they have to make sure that they're getting shareholder value. And that really is something to understand. In a year, they can have a flop, but it's not something that they want to see as consistent. So we want to look at tried and tested and true types of scenarios, but really we want to put everything together and then we want to test it all. So how do we build confidence? Well, when we put a plan together, and this is an example of the kind of thing we would look at, we would say, okay, here's your retirement paycheck, and this is what we have available to us and all the different aspects of our retirement plan. We know that each year we've optimized what is the best time to take CPP or take money from my RSP. You know, how do I reduce my taxable income? How do I look at it? But what I really want to point out is up here, where we can test all of these different, we can test many different scenarios. We could test many different scenarios in order to take a look at what the impact would be on your plan. So in this plan, for example, when we looked at all the different scenarios of a retirement income need and what you need for how long and everything else, in this scenario that we've built based on our recommendations, we were able to hit with in our statistics 134% chance, 134% ability of meeting your goals. And then we run it through a scenario to say, okay, let's crash the market number of times in this scenario. Okay, so that's here. We see the market being crashed. We still hit those areas. And then we say, okay, well, what if I don't die at 90? What if I live to 100 or 105? I can see the impact there. And then if my inflation is higher, what does that do? And I can build in strategies. How are we going to react? What are we going to do? And this kind of thing, this is what a retirement plan should look like. So you're always aware of where you're sitting and what options are available to you. And not just looking at what happened this year, but how does what is going on today and my goals today impact me 20 years from now? This is how confidence is really built. So you don't have to worry about the things that are going on out there, because they're going to happen again. So do we need to, you know, the stress that it causes, if we're going to really have a heightened sense of worry every time things go on, we might pull our hair out. But in 30 years, how many recessions are we going to have in the next 30 years? Is it going to be zero? I don't think anybody would agree with that. 1, 2, 3, 4, 5, 6. Well, statistically, probably at least 5. So how do we react? Or how am I going to weather that storm? And do we know how, do you know how you're going to weather that storm? Also, of course, which is very popular today, inflation is higher. What impact is a higher inflation rate really going to have on my long-term ability to support my lifestyle? I've also added in here disappointing returns. So knowing and being able to model and take a look at all these different scenarios, even if we don't know what exactly the scenario is going to be. Okay, so we're looking at conflict in Europe. Okay, 10 years from now, is it going to be conflict with China? I don't know. Is it going to be another financial meltdown, or is it going to be something else? Well, I can tell you what it's going to be. It's going to be something that nobody thought of. We didn't see Corona coming on. Leading up, there was very few people that would be able to predict or would know that the financial collapse was happening. Most financial experts were saying, oh, no, it's great. The tech bubble, everything else. Everybody, I'm sure that everybody here can probably agree that something's going on in the real estate market in Canada. What is that impact going to be? Is that a bubble? Is that sustainable? Can real estate prices continue to grow at 20%? Well, I would go back to 2007. And when people were saying in the US, when real estate were doing that, and say, yes, of course it can continue to grow up. Well, we saw what happened there. What's going to happen here? Well, we know that the government is taking action. They're looking at what they can do to slow it down. But is that going to be the next crisis? Is it going to be here in Canada? And how are you positioned? What's going to happen to your nest egg and everything you've worked very hard for to survive through that? So we hear about diversifications. That's great. Of course, if I put all my money in the TSX, that's not necessarily well diversified. We say that there's different companies in the TSX. I didn't just put all my eggs in one company basket. I want to diversify. So you go anywhere and they'll tell you, well, a bit of bonds, Europe, Canada, the US and such. And we know that that makes for a stronger type of portfolio. But does it end there? It doesn't need to end at the investment level, because the investments really are just a vehicle to help satisfy all the different areas that we really need to focus on. We spend so much time thinking about our investments when really we should be focusing more on the things we can control. So why don't we diversify our strategies? We can control the kind of strategies that we are implementing in each of our plans. So when I'm looking at my sources of income in retirement, I could possibly say, I maybe have my own corporation if I'm self-employed, and I have money there that I'm going to live off of. I have my investment incomes, my RSPs, CPP, OAS, other earned income, company pensions. There's a number of different sources of retirement income. Okay, so if I have different sources of retirement income, I can build more sources by diversifying my income. If all of my money is in RSPs, that's not diversified necessarily in my strategy. Maybe I want to have some alternative forms of income and such. One way we can mitigate our risk is looking at variability of the kind of pools that we would set up for retirement. So if we know that something like a growth portfolio has roughly a 70 to 75% chance of having a positive year in one given year, that still means that I could be pulling income at a loss when the year is down. But I know that for my growth, if I need to get growth out of investments at some point as well, I know that if I stick it with it for 5 years, that I have a 97% chance of positive returns. I like those odds. How can we apply that to an income model of different kinds of investments? Well, I can look at variability of different income investments. So quite often, and we have had a number of clients over the last couple of years who all of a sudden have a large pool of capital. They sell their house. Real estate market's high. I sell the house and here's $2 million. I need to live off this for the next couple of years. How do I make sure that I don't lose it all and that it's going to last based on a certain amount of income? Well, what we would look at is, well, I apologize. I have my daily expenses, my income, cash, something short-term that doesn't go up and down in value, that I have access to at the moment I need it. So the market goes down this year, it's down 10%, but I know that I have enough income to last the year or more because I've set that aside. Now, putting that whole $2 million in cash, well, that'll be detrimental because I do need it to grow. So what I then look at is say, well, how much money will I need in the next 3 years? Well, conservative investments would say that I may have a fluctuation within a 6-month period, but I know that 1 year, 2 years, 3 years, I'm going to have positive returns. Then I do the same thing with my moderate, more of a balanced. And then at the end here, I have my growth. That way that each one of these areas, each time I need this money, it's not going to be down in value. I can plan for that. So I'm allowing the ends. I'm allowing myself to get growth over here while maintaining a steady income on the left-hand side. So I have security, but I have growth at the same time. How else can we diversify our income sources and make sure that we're employing strategies that we have control over? Well, one thing we look at is what we call Series T. Now, Series T what this is a way of setting up an investment pool that allows us to take non-taxable income. Now, you'll hear me talk about tax a lot, because tax is generally going to be our biggest expense. And over your lifetime, it will definitely be your biggest expense. So instead of spending so much time trying to get an extra percentage point on my investments, maybe I should be spending more time trying to see how I can actually save more on my taxes that I can employ. I can employ it into different areas of my planning. These are strategies I can control. I can't control what's going to happen in the market. I can do everything within my power to try to get the result I want, but it's not guaranteed. The Income Tax Act is guaranteed. Now, you might say, yeah, I have an accountant and they do that. Well, the interesting thing is the majority of our new clients come to us from accountants. And when people go and people went to them, they said, oh, I went to my bank and I was asking them how I can save more on taxes because of these investments and such. And the bank will say, you need to talk to your accountant. Well, the accountant does help and they can give you some ideas. But to really mitigate tax, you need to be forward looking and not just looking behind. And your accountant will look at what happened last year. What we want to look at is what's happening in the years to come and what can we do today to make sure that we're consistently reducing our income or our tax owing. So how does this Series T work? Well, if I take that other amount, and this is our graph, and let's say that this is how much we put in. So this is our capital. Sorry for my writing here. Next, I'm going to look at, this is my growth going up. So we know that this is taxable. And this is what we trigger each year. Okay, this is non-taxable. Well, what the structure allows us to do, if you say that I need $500 a month extra income to supplement, normally, if I took money out, a portion of that would be taxable. But what this allows us to do is take that $500 a month solely from your capital that you put in. So that's how much you're taking out, which is non-taxable. And that's how we can lower your tax bills and trigger when we want to, and allow us to really sort of decide when we want to trigger tax, when we want to take tax, and everything else. Another thing that we look at is, well, how does insurance work? A lot of people think insurance is something that I put on myself because I want to make sure that my family is taken care of in the event of my death. Absolutely, that's life insurance. But what's wealth insurance? Well, for a number of clients that maybe have maxed out their RSPs and they have a large amount of non-registered investments, they also know that they're going to have a big estate bill. Having some insurance to help cover estate taxes might be beneficial. But did you also know that the government also allows money within insurance policies to grow tax-free? And we also have a way of taking money out of that tax-free, and we can provide an income. So if I'm looking at, say, an investment growth rate of 5%, and I had a marginal tax rate of 40%, and I have $100,000 that I was going to invest. And, for the next 10 years, I have another $20,000 that I can put into that investment. The traditional way is to say that, oh, I'm going to invest that money and I'm going to let it grow. Well, an alternative to that is, hey, maybe I get insurance and I put all that extra money into insurance. Well, what does that do? Well, the returns in insurance is guaranteed by the insurance company. Every year they say that this year, no matter what happens in the market, it's guaranteed. Manulife's at 6% this year, for example. Most of the companies, Canada Life, Manulife, Sun Life, they're all between 5 and 6%. And for the last 150 years, that's how long they've been doing these things, they haven't had a negative return, because their return is based on the amount of money they pay out versus the amount of money they take in. So if they take in $100 each year, they know specifically, exactly, that 10% of the people that they hold will pass away. So they only need to pay out 10%. The rest they can invest and give back to you as a guaranteed return. And in the event that something big happens, like say Corona, or an event like September 11th, or something that has a mass casualty rate, well, insurance companies have insurance on themselves. So they're pretty confident with those returns. So what does that look like in my retirement income planning? Well, if you look here, I put $200,000 in each investment. But at the end, I've spent all my investments and it gave me a taxable $15,000 per year. On the insurance side, I was able to get tax-free $27,000 and still have an estate benefit of over $1 million. How does that? Because this is how the benefit of insurance and sheltering taxation and the way the insurance company pays their dividends works. But it's not necessarily right for everybody. This is something to look at as another way of supplementing your income. We do this with all sorts of people, but it could be another source of retirement income that we put in. I've talked about the investment planning and how do we take the risk out of the investment? What should you do to make sure that you don't have to worry about the things you do save your money with? Well, one is to make sure that we don't sell when those markets are low and when we have those inter-year declines and everything else, is we need to take a lot of the guesswork out of it. We need to take the emotion out of it. Within our practice, we use a number of different strategies, and there's no just one silver bullet. And you'll have people talk about whether or not you buy stocks or bonds. You'll have people talking about ETFs versus mutual funds or institutional pools. We want to stay away from that product discussion, because that's all it is talking about a product. And sometimes different products are great for different people. Sometimes more expensive products are great. Sometimes cheaper products are great. But it's important to know and understand where their place is. But if I was just to turn on the TV, I would have arguments on both sides saying, oh, don't have high priced investments. Well, the highest priced investments out there, those big, massive hedge funds on Wall Street, why do people put hundreds of millions of dollars into that when they charge annual fees of 2, 3, 4, or 5% plus 20% of their growth? That's the highest fees I've heard. What are they doing? And why would people buy them? Well, because maybe they have a place. There's a reason for it. Low investments do not necessarily equate to an outcome. So let's take that product outside and say what we need to be doing in order to achieve your goals. Let's put our money where proven people put their money. When a company has a pension plan, where do they put it? They don't necessarily manage it themselves. they turn to big wealth managers and say, manage this pool of income. Now, these are companies that you don't have access to. Retail investors don't have access to them, but we can have access to them. We can have access to them because we don't buy their retail product. We pool a huge amount of client money and say, here's $100 million for our investments in the US. We want you to manage it because you're the best at that. So we may look at that. We're going to employ our volatility controls, like we discussed, the what I call the waterfall, the different buckets. And we're going to use a combination. We're going to have institutional pools and ETFs and a number of things there that all work in the same place. But I don't want you or any of our clients to rely on me to say, oh, we need to sell out of the Royal Bank and we need to do these trading. No, I trust these companies. So what we've done is we go around the world and we say, who is the best in the world at managing this kind of money? Who is the best asset manager in the US? Well, what we looked at is, okay, we've got JP Morgan, we've got Aristotle in the small cap, we've got Putnam, T. Rowe Price, and they're looking at different pools. And we'll do this around the world and see who's managing the right kind of money and doing what we want. But it doesn't stop there, because now we have expectations. We're going to make sure that we monitor what they're doing at all times. How are they performing? Are they doing what we need them to do for our clients? We're going to put the different managers together. And you know what? If they're not doing what we want them to do, we're going to fire them. So once we pick them all and we can put them together, it doesn't stop there. We don't just say, oh, okay, this is what your percentages should be and this is everything else. We need it to be dynamic. We need it to be able to manage itself and move on basically a tax efficient basis, but also be able to roll with what's going on in the markets. So it's an ongoing amount. So when I talked about taxes, it's important. Over 50% of people don't really employ any good tax strategies. They don't look at it. They just simply pack their money away. It is important to know that all the income that you're making in different kinds of investments is taxed differently. So our tax planning strategies need to look at all of this amount or all of these taxes that are going to be paid. Because the way we receive income really will determine how much money at the end of the day we keep in our pocket. Our GICs, which are safe and secure, that make no money, is also taxed the heaviest. Therefore, I'm not making any money on that. The same could be looked at with foreign dividends. Other things that we would look at putting in place, things like income splitting with your spouse, making sure that you're sharing income between the both of you if you can, to reduce your taxes. When I'm actually taking our money, should I start taking it sooner? Should I average it about the whole way through? Maybe, maybe not. But it's important that we can run the scenarios to say, we need to start taking your highly taxable investments earlier or later, because this is what the overall tax impact will be. On your estate side, it's very important to understand how your estate's going to be taxed, because the government's going to take half of it. So I'd like to tell clients that when you die, you can give your money to two people, two possible heirs. One is your family as heirs. Two is the government. And three is a charity. Two of the three you can pick. Most people wouldn't want to pick the government, but the way most people's estates are set up, it is the government. So how do you save on this? Well, one is actually understanding what can be done and what you're heading towards. Understanding your investment income and how that is analyzed and what you can do to mitigate any of that, any taxes on that side. I mentioned that charity. There's a lot of opportunity for people to use charitable giving in their estates and on an ongoing basis to reduce their tax bill. One could simply be, I've got securities or investments that have grown in value. Well, the government allows you to put that money in at its market value and not trigger any tax on that. So you save that money on tax and you get a charitable donation. If I'm putting money on a regular basis into a charity, maybe I want to establish something more formal. So for many of our clients, and Rob and myself do this, so we have our own charitable foundation. And each year we can put money into a charitable foundation and receive a nice charitable tax credit. But I can also put this in my estate to make sure that my estate makes a charitable contribution instead of writing a check for taxes. We discussed insurance and the different ways of an alternative way of using that. As you'll see here in the beginning, that's insurance where I say, I want to make sure my family is taken care of. Here is, I want to make sure my nest egg is taken care of. Do I need a trust in my estate? Does your advisor talk to you about the use of trusts? Is it something that's just for ultra rich people? No, it's something we work with all the time. And it can be a very effective way of making sure that after you've gone, that everything is done according to plan. If something happens and my kids are under the age of 18 and there's nothing in place, the moment they become 18 years old, they get all that money. How would an 18-year-old handle an estate of $1 million, let's say? Or how can I use a trust while I'm living? I've got more money than I need. How can I use a trust to make sure that the government doesn't take any on tax on my estate? So that's very important in a financial planning and estate planning perspective. So I want to quickly run through a little bit of a case study on putting a number of different planning strategies to work. So one is Lee is 59 and Peter is 58. You see that they have a number of different kinds of accounts. They're heading into retirement, and you see that about 1.3 million. We've got GICs and non-registered. We've got RSPs, tax-free savings accounts. I mean, they've done a very good job at saving. They want to look at what their planning looks like and want to have a better handle on things. What are they doing right now? Is it effective? And this might be very common. We say, okay, well, they've got RSPs and they've got TFSAs, so that's good. Is that effective retirement planning? Well, what do we know on them? Their plan is that they want to draw on their RSPs early to reduce their tax bite. They have a cottage. They want to transfer it to their son because they don't want the tax bill to get too high. They had the GIC set aside to cover that tax bill. So that's in their plan. Their son, however, doesn't have any savings, and he's actually engaged in someone that they barely know. That's quite important, because how does marital property work in terms of divorce? What are the legalities behind any inheritance that they may have and everything else? Their plan is also to use their tax-free savings account for annual shortfalls. All right, so let's put that together. We analyze their expenses and we see that their expenses are roughly fixed of about $72,000 a year. That's transportation, food, property tax, discretionary, everything along those lines. Travel. So $72,000 a year is what they need. They have fixed income $55,000 coming from a pension. So that's doing a lot of work for them. That's great. CPP and OAS, they get interest from GICs, and then basically they use their RSPs to fund the rest. So this is quite common. But when we do the analysis, we see that based on their strategies, they could run into problems if they live too long. We see some big shortfalls here. So we know that they potentially can run out of money if they live too long. So, I mean, essentially, if they live into their high 80s or early 90s, that they'll have run out of cash. So we want to look at employing some tax planning strategies to make sure that they're reducing their amount of tax. So we're going to do splitting of their income for pension. We've decided we're going to look at redeeming RSPs later instead of earlier and see what that impact is. Instead of a GIC for their guaranteed income amounts, we look at an annuity. It's much more tax preferred, and it can provide the same levels of guarantees. We want to optimize their tax-free savings account to make sure that we're actually, if we're sheltering tax, we might as well get some growth out of it to defer those taxes. And we're actually going to look at, instead of transferring the money to the cottage to their son now, let's do it later. So their initial chance of success, we saw those big gaps, was about 66%. So after we input everything, let's add up each kind of change. So if we do their income splitting, we get up to 67%. Okay. We're moving in the right direction. But we see, if we change that order of redemption of when they're taking the money from their RSPs and their taxable investments, we can actually have a very substantial impact, up to 83%. Okay, what about the next thing? If we buy an annuity instead of using a GIC for that income, we're up to 89% now. If we're optimizing the TFSA, so that's a very simple thing that we can do, up to 92%. And then, of course, by deferring the cottage, we're up to a 95% chance of success in their planning. So all of the things that we implemented here are things that you can do. It's not market reliant. It's not guessing and saying, oh, I think that this market's going to do better, these kinds of stocks or this kind of investment's going to do good. These are all strategies that you could implement, and you see that we have about a 30% chance increase by just simply making some simple changes in their planning. So how would we go about doing it? How do you go about doing it? Well, one is definitely understanding that you need to build a team around you that's going to look at all these different areas. So you may have lawyers and accountants. We have them as well, but we work with other people's lawyers and accountants to continually put all this kind of information together. We use our own in-house specialists, and essentially you want a team that can help you with almost every aspect of your planning. Not a 1-800 number, not a pop into a branch once a year, but someone that's consistently involved in your financial affairs. They know the situation, not just what they see in a file from last year, but they're very much in tune with your situation and what the plan was that you implemented. So we go through a very thorough analysis on exploring your situation, your goals, your objectives to develop these plans. Then we would implement it and make sure that on a regular basis, we are actively monitoring and adjusting it. We want to make sure, and what you can do to protect what you have is, one is sticking with your plan, knowing what the big picture is, because the market events are going to continue to happen. They're always going to be around. So having a plan and sticking with it. So when you see something or you read a headline or hear about something, you're simply saying to yourself, we knew this was coming at some point. We can get through this. making sure that your investments aren't just made on a whim. You're working with the best kind of investment managers for the money that you do have invested. Diversify your strategies. Don't just count on one income source or one simple way of providing your income, and understanding what those sources are going to be. And then, of course, building your team around you that continually are there to make sure that you understand everything and that you're prepared. One thing we do know is that if you set up this kind of structure, you're setting up working with advisors for this sort of thing and choosing to do it, we do have evidence to show that those who do it have over double what a person who tries to go it alone does. So understanding the team approach and the professional advisor approach has quantifiable results. Our team works with people of all different levels and everything. And we manage, we help clients navigate through all different aspects of their finances because everybody is completely unique. There is not just one thing I can say, you need to do this, or saying that everybody needs to have an RSP or everybody needs to invest this way or that way. It's very important to have a very thorough understanding of what your plan looks like and how you're suited to basically be able to enjoy your retirement and not have to worry about necessarily the day-to-day of your finances, unless you really want to be that involved in it. But we have a lot of clients who want to enjoy life and be out there and not worry about this sort of thing. So when building your team, we're happy to speak with everyone. We don't necessarily work with every single client or person that comes our way. We want to make sure that there's a right fit based on the kind of planning that we want to do, and that we're able to build a long-term trusted strategy. And that sort of brings me back to our initial question of how many holes does a straw have? And the reason I asked this question, it's much like financial planning, because if I went out and said, where should I put my money? And I was at a cocktail party, I would get a number of different answers. Or if I turn on the TV and say, what should I do because of interest rates? Or when it comes to finances, there's so many different opinions out there. And a lot of times with financial planning, they all have merit. But there's only one opinion that is, or one answer that's right for you. And no matter what you select on here, it doesn't mean that that you're wrong. It's just understanding that there's different ways of looking at everything. And it's important to be able to see the different perspectives. And your advisory team should be able to show you the different perspectives and discuss the different perspectives with you. So how many holes does a straw have? The accepted answer, or the common answer, is a mathematical answer. It's one. So it's more of a rational answer based on topology, whereas the hole, it is one large hole that goes through a straw. Now, I could argue that a straw has no holes. If I punch a hole in the side, I would say my straw has a hole. If I cut my straw in half, or if I don't have any holes in the straw, then it ceases to be a straw. That's more of a philosophical angle, I would say. But you can make that argument. Number three, do they have tool? Well, yeah, one at each end. And this is probably where most of us would sort of have our mind go to. One at each end. A straw has a hole at each end. But again, the point of this is that there's three answers. And if you bring this question in a cocktail party or with a group of friends, you can debate it till the cows come home on the merits of each question. And you would have the same kind of debate as if you asked a group of friends or a group of colleagues or anything, a financial question. Nobody knows every single thing about your finances the way you do and the way your advisor should be. Therefore, the information that you're taking, the decisions and the advice you're taking should be done in the context of knowing your exact situation. And just because somebody has made millions of dollars in real estate doesn't mean that that's the way to do things or the right way for you. Or if somebody is buying speculative investments or investing in GICs, it's the same thing. There's multiple ways of looking at things, and we need to consider them all. So I'm going to open it up to Rob to see if we have any questions or anything now. I like to sort of end on this slide because one of the biggest detriments to progress in any financial planning is procrastination. And so I cut out this comic a while back because I always found it kind of funny. But Rob, is there maybe any questions that...
Phil, there was just one question, which I think you almost just answered, which is, in your opinion, what is the worst thing that I could do right now to ruin my retirement?
That's a good question. What is the worst thing that I can do right now to ruin my retirement?
Yes.
That's interesting. Actually, it sounds, maybe you're a follower of Charlie Munger and such, who in his investment decisions used to say, what is the worst thing that could happen? And just don't do that. And then you'll generally do fine. So I would say that the worst thing that anybody can do in their retirement is to do nothing. Absolutely do nothing.
Okay.
So it has been shown time and time again that somebody who sits with money in their mattress and they refuse to make a decision, or they put it off a year or two, that's what impacts people. I've had the conversations about inflation, and if we have inflation at 6% right now and somebody says, I don't want to do anything, I'm just putting money in my bank account because it's there, I can get at it and it's safe, you're guaranteed losing 6% per year right now. Cash is the worst thing you can do with money in a high inflationary environment. I would also argue that the worst thing you could do right now is to put your money into something that you don't have access to. So a lot of people get on this real estate hype and say, I'm going to take all of my money and I'm going to buy real estate right now. I would say that that is a very risky decision, because one, real estate is not something you can just sell out of and get out of. Two, it's very high. I think many would agree that we're at a peak. But that being said, you're still at least buying an asset. The worst thing that anybody can do really is to not do anything and to at least not explore their options. And
hey, I got one more question. Well, not one more, but the three questions just came in. They're all the same question, which is, I didn't hear anything about service fees. Can you elaborate on that? What
Absolutely.
is the cost of going with you?
That's good. Okay. So unlike an accountant or a lawyer and such, we don't charge to build plans or to put anything together. Generally speaking, our compensation comes from an advisory fee. So that is determined based on the planning and the portfolio size, and we can discount as time goes up. But if you're invested almost anywhere, that you would be looking at paying some sort of advisory fee, unless you're doing it on your own in the market. So if you are working with an advisor, it will be comparable, if not, usually we try to come in, we are a bit less than a lot of clients that we've brought on board that we've seen. If you're someone who's doing it on your own, of course, that advisory fee is something that's taken from, it comes out of the investments. But I can tell you is that I don't like costs in terms of paying too much for what you get. So when I was using the hedge fund example of very, very high fees and such, people pay that because they're getting something for it. We don't sell those, but that's sort of the premise. We want to make sure that we're having a very determined impact. So what I can say is that our any cost of working with us is definitely mitigated by the benefit that we'll be able to show you in your planning. So I can't give you a specific number. What I can tell you is that if you've been investing in the past, you've been paying these kinds of costs already, whether or not you've been getting service or advice at all. So when we go through this, and we would build a plan and everything without it costing anything, and we would show you all of these costs and everything up front, and you can make a decision at that time whether or not it's worth it to you to work with an advisor. But
Thank you very much for that.
It would be very counterproductive for it to be detrimental to you and not have a much larger benefit to you.
Thank you very much for that, Phil. Thanks for the presentation this morning. Thank you all for joining us and giving us a part of this Saturday morning. We encourage everyone to go out, and actually another question just came in. If we hold a bond fund now, should we cut our losses as soon as possible as the interest rate hike will substantially reduce the value of the bonds?
That's a good question. It depends on the bond fund. Unfortunately, there's a lot of different kinds of bond funds. Some are more passive and some are more active. What you'll see in these kinds of environments is most bond managers are looking at reducing the duration of their bonds. So the maturity amounts of each bond that's within a portfolio. This will help mitigate any risk that's going on with increases in interest rates. So you may have shorter term hits, but remember, bonds also have a monthly income yield. So depending on the bonds that they're currently holding and the maturity levels and such, that might mitigate some of the risk and some of the volatility. But most bond funds will have a good combination of different durations. You may see some short-term impact, but hopefully, depending on the manager, if they're active, then you'll see them diversifying those durations to have basically a less of an impact of these kind of interest rate movements. Shorter term bond funds are going to do better in this kind of environment. But what you do, it really kind of depends. If it's a passive one, it might have a bit more risk on that side. And really, the next question is, outside of that, is where does a bond fund fit in your portfolio? So we're talking about something very product specific. I don't know what its role is in your portfolio and how it equates to everything else. So it's important to take a look at it in the context of everything. I hope maybe clear as mud, but maybe that gave you something to take away.
Thank you very much, everyone. Have a fantastic day. I've put a link into the chat for you if you want to reach out to us afterwards. We hope you do. We'd love to talk to you more about this and keep the conversation going. But that's it for now. Enjoy the rest of the day, and thanks all.